Hi, Ketki. It's great to see you again. So the big story this week in Canadian markets was obviously the Bank of Canada rate hike. What's the bank's rationale behind this relatively aggressive rate hike? And what's the path going forward?
Hi, Simon. So yes, this week the Bank of Canada hiked its benchmark interest rate by 50 basis points to 1.5%. It is a relatively aggressive move as the second consecutive 50 basis point increase as Canada's central bank tries to tame soaring inflation. At 6.8%, inflation is well over the bank's mandate of 2%. The bank also announced it will continue quantitative tightening and warned that it will be even more forceful if necessary to combat inflation, which is really the bank's rationale for moving so aggressively to combat inflation, which the bank noted, I quote, is persisting well above target and expected to move higher in the near term. In terms of the way forward, yesterday, Bank of Canada Deputy Governor Paul Beaudry announced that rates will need to be at 3% at least to tackle inflation. That's largely in line with analysts' expectations. Analysts expect rates at 3.25% by early next year. The immediate next step is likely to be another 50 basis point hike on the 13th of July at the bank's next policy meeting. Of course, that the next move does depend on the economic indicators, but at the moment, those economic indicators suggest aggressive policy tightening going forward.
Right. So you mentioned that the data suggests aggressive tightening going forward. What major data is the bank looking at, and what does it indicate so far?
Right. So the main thing that the bank will look at is inflation. That's the bank's core mandate is to keep inflation at or around 2%. So obviously that indicates need to move very aggressively. The bank's challenge is not just to tackle inflation, however, it's to tackle inflation without upsetting the economy. At the moment in Canada, the economic recovery remains fragile as we move forward from the extended COVID-19 lockdowns. So the bank will look at GDP, which is the key measure of economic growth. We also had GDP data come out this week. GDP increased at 3.1%, representing a significant slowdown from last quarter's increase of 6.6%. GDP also grew slower than analysts' expectations at 5.4%. But importantly, the data was in line with central bank expectations of 3% economic growth. So GDP is growing in line with central bank expectations, which indicates, again, aggressive rate hikes. The last thing the bank will probably be looking at, or the other main thing the bank will look at, is employment. The Bank of Canada does not have an official dual mandate of full employment as in the US, but it has adopted employment as a de facto dual mandate. So payroll employment is at an all-time high. So our vacancies, the Canadian employers are recruiting for over 1 million vacant positions at the beginning of March, which is a record high. So all the relevant indicators that the bank will be looking at say the Canadian economy is go for aggressive policy tightening.
Right. So what effect is the prospect of rate hike having on equities, not just on the Bank of Canada, but also in the US with the Federal Reserve? What is the state of risk sentiment in the market?
Right. So in the immediate aftermath of the Bank of Canada rate hike on Wednesday, we saw a huge dip in Canadian equities. But by and large, the Bank of Canada rate hikes have been generally priced in to the market. So what's been dominating markets recently and causing extreme volatility the past week, not just on Canadian, but global equities, is the prospective actions of the Federal Reserve, which is the world's most powerful central bank. It's been, as I said, a highly volatile week. The Canadian index and global equities have been dominated by US economic indicators. Investors are essentially betting on what these indicators mean for the economy and consequently for Fed policy. Any data that's worse than expected has the markets reacting in jubilation because it indicates the Fed will not be as aggressive. Stronger than expected data like today's jobs report indicate the Fed will be more aggressive, and that markets don't like that very much. Corporate America, interestingly, does not think a soft landing will be possible because they believe the level of monetary policy tightening needed to combat inflation is going to be quite heavy. The Chinese slowdown is, again, an added concern. So in the last week, we've seen warnings from various bank CEOs, including from JP Morgan, Goldman Sachs, and of course, who have warned of an economic hurricane. And of course, we've had Elon Musk chime in with his 2 cents, noting that he has a bad feeling about the economy. And he's also announced a hiring pause and 10% layoffs at Tesla. Today, the CEO of Citigroup, Jane Fraser, became the latest CEO to warn of the global economy, warning that Europe is even more likely than the United States to slip into a recession. So those are quite dire warnings for the global economy, and we'll have to see how it plays out.
Right. So let's hope we're able to avoid this recession. Again, Ketki, always very interesting. Thanks for doing this.
Thanks, Simon. We'll chat soon.
Yes.